Welcome to the Business of Writing. I'm Joe Solari. You can tell already that the format of this episode is a little bit different. Later on, Craig and I will be having our typical conversational piece where we talk about some of the subjects of today's video. But to begin with, I wanted to walk you through some slides to show you how you can start thinking about the value you're creating in your writing business. So let's get started. So let's get into the economics of your self-publishing business. I think the easiest way to start this process is to talk about the different building blocks and visualize how your business is built up. The basic building block is the book. So you write a story, you get it a cover, you get it formatted, you go out and you publish it. You need to understand the economics around that specific book. If that book is built into a series, then break-evens may be different within that series. A standard tactic is to have the first book either free or at a lower cost, say 99 cents, as a tactic to get people to read that book and then want to read into the series where maybe the next books are costing $2, $3, $4, $5 each. So, understanding each book's break-even as well as how the series economics work, that now becomes each book's break-even and profitability, and then read through in the series. So the more that people read through and buy the next book and the next book, or read pages if you're using Kindle Unlimited, the more that series becomes profitable. And as you write series, you build a portfolio. And understanding how the different series work in context to each other is important. The objective being is to understand the value that we've built and how we're building that value. For instance, breaking into a new genre with a new series may end up costing more, and understanding those costs will help you to have the right working capital to get into those new series. Or just understanding over time that certain genres have different economics built within them. So now let's look at this another way. Your business is to create content and then to market this content. When you're doing this, you're creating a revenue stream. There's costs associated with both the content creation and the marketing. What's left over after those is your profits. This is your free cash flow. And you've heard Craig and I talk about cash flow quite a bit. It's the lifeblood and the oxygen of your business. The other important thing about free cash flow is this. Every single business on this planet, in the end, is valued cash flow that it creates. I am now going to show you a pretty scary formula. You don't have to worry about this formula. You can figure this out in Excel when you do need to use it, and you don't need it right now. But this is the formula called net present value that is used to determine the value today of future cash flows. So in the instance of your book writing business, if you had stable cash flows that you could project out into the future, you could take those numbers and determine what it's worth today based on the future cash flows that they will generate and the riskiness of that estimation. Again, don't worry about net present value of your future cash flow. I'm just trying to get your head around the idea of cash flow's importance, not just in your ability to pay the bills today, but what the value of your business is worth in the future. Break-even is the basic performance indicator we're going to use with a book. It is going to let us know when we start to make money on that book. And it's pretty simple to figure out. Your break-even is your costs, and then we're going to divide in the profit, so your royalties, into that. Not your actual book sales, but the revenue that you get. In our example, we're going to be talking about a 99-cent book where you're getting a 35%, a 35-cent royalty. So when you're thinking about your actual costs, you have a couple things to consider. One is the bulk production costs of getting your covers made, your editing, your formatting, any of that stuff that you do to get the initial book out to market. And then there is additional ongoing costs that you may have related to the marketing. So you may, in the first month, have $50 in marketing costs, then another $50 or $100. We're going to want to capture all that at the book level and figure out our break even. So we have a base break even number that's going to then have additional cost added to it as time passes by. So again, here's the example of, let's say our total cost to get the book ready was $300 in covers and editing and formatting, and then another $50 that first month in marketing, 35-cent royalty. That means we have to sell 1,000 books to break even. Now let's look at that over time. Here we've got a scenario where we have 4 months. We're using the same data again, starting with our $300 for our production costs, and then marketing costs. In this model, we're actually starting to ratchet them up as time passes. We then sum those numbers as we go forward, and we compare them to monthly revenue. Not your sales numbers, but your royalty numbers for that book. Now, what you'll see here is an introduction of another indicator that I'm going to talk about, cash on cash return. And we're taking the total revenue in comparison to our sum of marketing costs to get that number. So the thing to think about with cash on cash return and break even is that when you get to a cash on cash return of 1, you have broken even. Anything above that becomes profit. So this becomes a simple measurement of how your book is doing. Now we're going to go and listen a little bit to Craig talk about how he's done things and kind of where. So we've talked about break even. Now we're going to go and listen to a conversation between myself and Craig where he talks about when he started and where he started from, because he had some experience in business prior to going into writing. Then when we come back, we're going to talk more about return on investment and cash on cash return and the internal rate of return.
So let me start off with a question for you, Craig. When you got, how do you think about your profitability with your books, and how do you do this measurement yourself? And I'd like you to kind of jump in the Wayback Machine, and you remember that show, right?
Oh, you bet. You bet.
And
I think it was a cart. I think it was like a refrigerator box. Wayback Machine. Not sure.
I don't remember. Yeah. But go back, like when you first got started, how was it that you were looking at this, and how has it changed over time? And maybe talk what you think were some of the, what are the things that are most important for you to look at when you're launching a book and monitoring its performance?
I started at a different level because I came to publishing and writing as a business diagnostic specialist and business consultant. So while I was writing my first book, I actually put together a spreadsheet for tracking. It took in revenue versus profit versus read through versus KU payout, and it automatically calculates charts and stuff like that. I posted a draft of that spreadsheet on 20 books, and I have upgraded it many times since then. I'll work on that, but damn, I've got a lot of data. I've got 10,000 cells of data that I would have to strip out, and it's time consuming to do that, but I'll do that for the good people here, because it is the business of writing. The one shortcoming, had 8 books in a series when I set up the spreadsheet to calculate read through, because that is critical when calculating your ROI, especially for book sales. When you put your first book in a series on sale, for 99 cents. If it's a countdown deal, hey, you get 70 cents out of it. If it's not a countdown deal, you get 35 cents. How do you strip out your delivery fee? If you're in Kindle Select and somebody downloads your book, you get $4.90, but it's a behemoth book with a lot of images inside. You might actually only be getting 50% on that, not 70% after they strip out the delivery fee. I did not deduct that from my taxes last year. I didn't think about it, but my delivery fees came out to $1,400 in 2016. And I'm like, oh my God, I could have deducted that and would have only paid about 500 or paid about, say, 800, 900 on that money. So I donated $500 to the IRS. So if I ever get audited, I'll get that money back because I have that. But that's how you need to track. You need to track to that level of fidelity. Now I do all that because I pull in Amazon's raw data, and I do it every day. You don't need to do it every day, but I'm a data geek, and I like looking at the numbers and seeing. I've got 21,000 sales of my my books with. I think it was at 60,000 downloads. And that's without the co-written series. That's just my backlist books. But I can tell you to the exact number how many books have been downloaded from Amazon. And unfortunately, I can tell you how many have been returned as well. My return rate seems a little higher, but I think that's because of the box sets. But I can analyze that data. I have, like my book one, Free Trader, 6 books in that series, Free Trader 1. I also included in the Free Trader box set, books 1 to 3. I included in the Martell library, which is Free Trader 1, Cygnus 1, Rick Bannock, and then a short story. So I'm seeing returns of number 1, and I think that's what it is. I've gotten people into the Martell starter library through a lot of and I'm saying library. My lips are still numb because it's 5:15 in the morning here. I've gotten people into that because I've done huge marketing campaigns with that one, and so people are picking up 1 thinking they're getting a new book, but then I'm seeing the sales of book 2. All of that data is there, and so that gives me my full perspective. My read through from 1 to 2 is 10-20%, which is pretty good considering I've given a lot of book 1 away. But then 2 to 3, now it jumps to 75%. So my whole goal now is to get them to read book 2. So I'm putting 1 to 2 together in a big marketing campaign that starts next week. And that's my biggest ever marketing campaign. And I've been in this business 1.5 years. I've sold with the co-written titles with Michael Anderle. I've sold well over 100,000 books. Not alone. And that doesn't include page reads. I had over 5 million page reads last month. All of that information you can take and look and see how you want to progress. And what I saw is that, hey, I need to sell 1 and 2. That's all in my spreadsheet, and I track that way. So I tracked from the outset, and that helped me make better business decisions in regards to which way I wanted to go. Marketing campaign, I track that. I track every single expense every day. I don't use Wave. I'm not a fan of websites digging into my bank account information. Because I can do it myself, and I actually prefer to do it myself. Sure, I may overlook some things, but I can touch it, and I touch it every single day. That also helps me avoid identity theft because I see those expenses every day. I see my bank account every day, my business as well as my personal, and that's just part of my daily routine. So I ambled and rambled enough. Did I answer any of your questions?
Yeah, you did. You made me think of a couple more. So how would you, so let me just say this. I think one of the things that you made me think about is, you said, I've been in this business 1.5 years. And if somebody from the outside heard that, they're like, okay, you're pretty green, but like in this industry, that's a long time. Right. Like, and I think,
the industry is, it is what it is, but 1.5 years from when I published, I've been, actually next week, I hit 2 years of being a full-time author.
Mm-hmm.
And I've got almost 2 million words in publication because I write every single day. I take my words and I gin them and turn them into books. And those books then go out to the marketplace and unto the world, and they can look at me through those books. I get better with each one. That's just part of the continuous improvement process that I embraced pretty much my whole life, and definitely as a business consultant. So there's some intentionality there, because I also track my word count. I have everything on one spreadsheet, like my terms for certain series. Who are the characters? What are their traits? That's all in this one massive spreadsheet, which is backed up. I back that up every day, because holy shit, if I lost that one, oh my God, what would I do? That's everything is right there. But that's a 2 million words. That's a lot to track, and 50-some thousand books downrange. That's still a lot to track. That's a lot of information. If you publish one book a year, your information and data tracking will be easier, but also it's limited scope, because you may have a bad blurb and don't realize it because you're looking at different things. When you look at it with a larger data set, and you know this being a data guy, the bigger the data set, the better your analysis is going to be.
Oh yeah, I mean, there's the law of large numbers. You know, that's the whole basis of statistics. If you get a big enough population, then the data, you know, your assumptions are more and more accurate.
Yes.
So I know you're doing the same thing. You're collaborating in other people's work, like with Michael, but you're also working. You're kind of running a stable of authors too now. So how are you thinking about that differently?
Now that one is because not all authors look at expenses the same way, because it's easy to look at revenue and say, hey, this book is going to make $10,000 to $20,000. Cool. But if you do a custom photo shoot, you start doing custom covers, you start your marketing campaign, you build a website, and pretty soon you've got $10,000 in expenses, and the book isn't even written yet, or it's written, but the public hasn't seen it. So the risk changes exponentially. For me, last year, as I was writing my own books, I managed all my own risk. So I spent money, and I was in the red through the whole year. Through come December, finally, the December month put me in the black. But the first part of the year, there's somebody posted on 20 books, hey, what's it take for you to make $75,000? That's your number. And most people are, well, hey, it depends where you live. It depends what your expenses are. And I looked at it, I'm like, man, that's pretty much right on. Last year, I needed 75,000 banked in order to write for that whole year. Now, I have retirement, I have other revenue streams, but that's about what I spent into my expenses for writing, which were about 25,000, because I bought 2 years worth of covers, all custom, and editing and all that ancillary stuff. But then living expenses, I took all that into account, and that's how I managed those expenses. I wasn't worried about those costs because I had that money. As you're going, if you want to get into a new universe, say, hey, I'm going to go full steam ahead. I'm going to tear this up. I'm going to do it right. Well, that's where you need to look at those expenses and say, damn, if this is a home run, I'm starting right now. 6 months from now, we're going to publish the first book. If this is a home run, it'll make 10 grand. Well, 2 months beyond that, you'll get that money, and you will have incurred those expenses all of this time leading up to then. So you have to have that bank. With the collaborators now, that's a different perspective for me. I could spend what I wanted to because I had it in the back of my mind. Now I actually have to track those or buy each book because I want to see the cost per book and especially how they pan out. I was talking to a collaborator this morning and said 8 books is what we're looking for. 8 books to maximize profitability, because the first book will not be profitable simply because it's going to be 99 cents. We're going to hit it with countdown deals. We're going to market it, and it's going to have the highest level of expenses. And we'll get people into book 1, but will we get them to book 2? And that's how shape that. And then book 2 starts that profitability where your expenses go down, your profitability goes up, and then you have that delta, that difference in between. That's your money. That's how much you've made. So if we can get that first book, especially if we can make that first book profitable, and that's where I'm looking at with the collaborators, is how do we minimize those costs on that first book to make that one in the black. Because if the first book's in the black, you've got a home run. You've got a home run because you can move forward from, and your delta, you will have a delta from the start, and then you want that to grow.
Mm-hmm.
You keep your expenses, especially if you build your organic readership, all things that we need to do. Now we're going to have a higher marketing campaign because of it's a new genre that we're tapping into, space opera. So gathering those readers. So we may be kind of hovering with a static profitability, but
Sure.
then that'll grow once we build that organic readership and expand the number of volumes available.
Mm-hmm. So in that case, you've got some readers that are going to come over from maybe some other genres because they know you, but in a lot of respects, you're just starting from scratch.
Yes. Well, we're counting on the base readership to come over from the Kurtherian universe
Mm-hmm.
to keep us even.
So I hope you found that conversation between myself and Craig helpful. He uses a more sophisticated method to track his business. In fact, he's tracking all of his business from word count through to profitability. But for those of you that are just getting started, you now have a performance indicator in break even that is fundamental in how you're tracking your business. So when you look at a book, you need to start figuring out break even. And I challenge you, even if you haven't published your first book, to start to think about this and just on a piece of paper, figure out the math on what you've tallied up to date on costs, and then determine based on the pricing that you plan to use how many books you're going to need to sell. You can also do the same thing with Kindle Unlimited by applying the current rate of page read to determine how many page reads you need. I have a little more sophisticated process that I use where, knowing that there's like a 70-30 split on purchases of books to page reads in Kindle Unlimited, I can then apply that to come up with the estimated page reads and purchases combined that will make. Again, understanding this and playing around with these numbers on a sheet of paper or on the calculator on your phone will really help you to get a grasp on what the economics of a book are. So let's talk further about return on investment. I introduced you to the concept of cash on cash return. And we're going to talk about internal rate of return. These are measurements of the performance of capital, the money that you're spending. What's the difference? Well, the simplicity of the formula. I'll show you these two formulas in a minute. One is very, very simple. It's only got two components to it. And the other fundamental piece is the function of time. Internal rate of return has that time value of money built into it. And I'm going to go through some examples here that'll help you to understand those differences. So here's the formulas. Your cost of capital has the future value divided by the present value. That's it. When you look at internal rate of return, you're determining this present value by using the future value that you have and then dividing in a function of time. So it's the rate and the number of periods. I think rather than staring at those formulas, the easier way to get your mind around this is to look at this table. Up here, we have the cash on cash return for the example I gave you earlier. We spent $575. Our return was $2,500. In our model, we had a cash on cash return of 4.35, and the time period for that was 4 months. So typically when you're looking at an internal rate of return, you do it over a period of years. So in this example, this first line, we will say we are looking at a $575 investment that gets us $2,500 in 1 year's time. And that gives us an internal rate of return of 335%. If we take that same 575 and we make that nothing in year 1, and that all comes in year 2, our internal rate of return is 109%. Still the same cash on cash return. And in our final example of 3 years, your final number of $2,500 in year 3 with that same investment gets you a 63% internal rate. Now, to put these numbers in perspective, a high-performing private equity firm typically is getting somewhere between 20 and 30% internal rate of return on investments. So if you're doing book deals that are looking like these numbers of 20 to 50 to 100% internal rate of return, you have a fantastic business that you should be putting more time and effort into.